Florida is booming in 2026. People are flooding into Miami. Tampa keeps expanding. Orlando's housing market refuses to cool down. South Florida real estate prices are still shocking buyers from across the country. But head north, it's a completely different story. North Florida isn't seeing the same demand. It isn't attracting the same headlines. And in many areas, homes sit longer, wages stay lower, and population growth lags far behind the southern half of the state. So what's really going on? Why is one part of Florida exploding with growth, while another part struggles to compete? Today, we're breaking down why fewer people are choosing North Florida, from job markets and income levels to infrastructure gaps, storm risk, insurance costs, healthcare access, and economic stagnation in certain regions. And this isn't about attacking communities, it's about understanding the divide. Because Florida isn't one market, it's two very different economies living under the same state flag. South Florida thrives on international money, tourism, finance, and migration. Central Florida benefits from entertainment, tech growth, and steady development. But North Florida? In many areas, it's more rural, more economically limited, and more vulnerable to structural challenges that don't make the headlines. That difference matters if you're thinking about moving, investing, retiring, or buying property in 2026. Before we dive in, hit the like button so more people see the full picture of Florida, not just the highlight reel. Subscribe and turn on notifications for honest breakdowns of housing markets, migration trends, and the states people are really choosing and avoiding. And drop a comment below. Would you live in North Florida? Or is South Florida the only part of the state you'd consider? Let's break down why North Florida isn't attracting the same demand, and whether that could change in the future. Regions number 1. Jacksonville and surrounding areas. Jacksonville is technically the largest city by land area in the continental United States. On paper, that sounds impressive. Big city, coastal access, growing population, expanding infrastructure. But here's the issue. Scale hasn't translated into the kind of explosive demand seen in South Florida or even Central Florida. In 2026, Jacksonville's economy remains heavily tied to logistics, military presence, healthcare, and regional corporate operations. Those sectors provide stability, but not the kind of high-income acceleration that drives major wealth migration. You're not seeing the same level of international capital, tech concentration, or luxury development that fuels places like Miami. Income levels in Jacksonville are noticeably lower than South Florida's major metros. That directly impacts housing appreciation. While prices have risen over the past few years, they haven't reached the aggressive, investor-driven levels seen further south. And for some neighborhoods, growth has stalled entirely. Crime perception also plays a role. While every city has good and bad areas, Jacksonville consistently ranks higher in crime statistics compared to many Florida metros. That affects both relocation decisions and corporate investment interest. Then there's infrastructure. Because Jacksonville is so geographically spread out, it often feels more suburban than urban. Public transportation is limited. Commutes can be long. The city lacks the dense, walkable core that younger professionals often prefer. And while it does have beaches and coastal access, it doesn't carry the same lifestyle branding or international appeal as Miami or Tampa. The result? Jacksonville grows, but slowly. Steadily, not explosively. That slower growth makes it less attractive to investors chasing appreciation and less magnetic for high-income transplants choosing Florida for lifestyle upgrades. Regions. Number 2. Tallahassee and the Big Bend. Tallahassee, Florida's capital, faces a different challenge. It's a government town in a state increasingly driven by private sector momentum. The local economy revolves around state government, universities, and related services. Florida State University and Florida A and M University bring student energy and seasonal demand, but that doesn't always translate into sustained high-income migration. Government jobs provide stability, but rarely explosive wage growth. Compared to tech-driven cities or financial hubs, Tallahassee's economic base is limited. Private sector expansion has been slower, and major corporations haven't relocated here in significant numbers. The broader Big Bend region faces even steeper challenges. Rural counties surrounding Tallahassee struggle with lower wages, limited healthcare access, aging populations, and minimal large-scale development. Infrastructure improvements move slowly, and private investment often bypasses the area in favor of faster-growing metro regions. Another factor is hurricane vulnerability. The Big Bend region has historically taken direct hits from Gulf storms. Insurance premiums have climbed sharply in recent years, and that's a major deterrent for buyers comparing options across the state. Then there's perception. North Florida feels culturally closer to South Georgia and Alabama than to Miami or Tampa. For some buyers, that's appealing. For others, it lacks the Florida lifestyle they imagine. In 2026, Tallahassee remains stable but not dynamic. The Big Bend remains affordable but economically limited. And in a state where people are chasing opportunity, income growth, and lifestyle upgrades, stability alone isn't always enough to drive demand. Regions. Number 3. Panama City and the Florida Panhandle Coast. At first glance, Panama City and parts of the Panhandle Coast seem like they should be booming. White sand beaches, Gulf views, tourism traffic, lower home prices than South Florida. On paper, it sounds like a hidden opportunity. But in 2026, the reality is more complicated. The Panhandle economy is heavily dependent on seasonal tourism, military bases, and service sector employment. While tourism generates revenue, it doesn't create the kind of diversified, high-wage job market that fuels long-term population surges. Many jobs remain hospitality-based, meaning income levels stay relatively modest compared to Florida's major metros. Then there's hurricane exposure. The Panhandle has taken direct hits from powerful storms in recent years. Entire neighborhoods have had to rebuild. Insurance premiums have surged dramatically, and in some cases, coverage has become difficult or expensive to obtain. Buyers comparing regions often hesitate when they see the long-term risk and rising insurance costs. Another issue is limited economic diversification. Outside of tourism and military presence, there aren't major tech hubs, financial districts, or corporate relocation waves hitting the Panhandle. That lack of economic expansion slows housing appreciation and reduces outside investor demand. Yes, beach properties still sell. Yes, retirees still move in. But compared to the explosive migration into Tampa, Orlando, or South Florida, the Panhandle's growth feels restrained. For many out-of-state buyers imagining Florida life, the Panhandle doesn't match the tropical brand they associate with the state. Winters are cooler. The vibe feels more southern than international. That difference shapes migration decisions more than people realize. Regions number 4, Lake City and rural North Central Florida. Lake City and the surrounding rural counties highlight another reason: demand lags in North Florida, limited economic drivers. This region sits along major highways and functions as a logistics and distribution corridor. That creates steady employment, but not rapid income expansion. Wages tend to be lower than the state average, and many positions are tied to warehousing, transportation, or small-scale local services. Healthcare access in rural North Central Florida is more limited compared to larger metros. Specialized medical services often require travel. For retirees, a key demographic moving to Florida, that's a significant factor. Housing prices are cheaper, but affordability alone doesn't guarantee demand. Buyers relocating from high-cost states often want more than lower prices. They want amenities, entertainment, dining, beaches, walkability, or strong job markets for family members. Rural North Central Florida offers space and affordability, but fewer lifestyle upgrades. There's also minimal, large-scale corporate relocation happening here. While Florida overall continues to attract business, most of that activity is concentrated in South Florida, Tampa Bay, and parts of Central Florida. North Central regions often get bypassed. Population growth remains modest. That means slower home appreciation, fewer new developments, and less investor attention. In 2026, Lake City and similar rural areas remain affordable, but they lack the economic catalysts driving demand elsewhere in the state. Regions. Number 5. Gainesville and surrounding areas. Gainesville is best known as a college town, anchored by the University of Florida. On the surface, that sounds like a strong foundation. A major university brings research funding, healthcare systems, student spending, and cultural activity. But in 2026, Gainesville faces a structural limitation. It's heavily dependent on one primary economic driver. The university fuels much of the local economy. When enrollment is strong and funding is steady, the city performs well. However, beyond education and healthcare, private sector expansion has been slower compared to Florida's high-growth metros. You're not seeing large waves of corporate headquarters relocating here. Tech presence exists, but at a much smaller scale than in places like Miami or Tampa. The housing market reflects that dynamic. Demand is strong for student rentals and properties near campus, but broader luxury migration has been more limited. Many buyers looking at Florida want beaches, nightlife, international airports, or booming job centers. Gainesville offers charm and stability, but not the same scale of lifestyle magnetism. Income levels are also mixed. University-related jobs provide stability, but they don't always generate the high-paying executive or finance salaries seen in South Florida or Charlotte-style banking hubs. That caps purchasing power and slows dramatic price growth. Then there's perception. For out-of-state movers, Gainesville doesn't always register as a Florida destination. It feels more inland, more academic, more regional. It's not declining, it's not failing. It's simply stable. And in a state defined by aggressive growth elsewhere, stability can look like stagnation. Regions. Number 6. Pensacola and Far West Panhandle. Pensacola offers beaches, military presence, and historical charm. Yet in 2026, it still hasn't captured the same level of migration intensity as Florida's central and southern markets. The local economy revolves largely around the military, healthcare, tourism, and small business. While military bases provide consistent employment, they also limit diversification. Government and defense-related jobs tend to offer security, but not explosive growth. Tourism remains seasonal. Summer brings visitors, winter slows down. That rhythm affects local revenue and income stability. Compared to Orlando's year-round theme park economy or Miami's global finance scene, Pensacola operates on a smaller scale. Hurricane risk again becomes a factor. Like other Panhandle cities, Pensacola faces storm exposure. Insurance premiums have climbed, and rebuilding costs after major storms weigh heavily on long-term investment decisions. Geographically, Pensacola sits closer culturally and economically to Alabama than to South Florida. For some residents, that's a benefit. But for new transplants seeking the Florida dream, the Panhandle's southern identity doesn't always align with expectations of palm-lined urban energy. Housing prices remain more affordable than much of the state. However, appreciation has been more moderate. Investors chasing rapid growth often look elsewhere. In 2026, Pensacola is steady and livable, but it isn't leading Florida's economic expansion. Regions number 7. Ocala and Marion County. Ocala has long been marketed as an affordable alternative to Florida's major metros. Located in north-central Florida, it's known for horse farms, rolling pastures, and lower home prices compared to Tampa or Orlando. At first glance, that affordability seems like a competitive advantage, but in 2026, affordability alone hasn't been enough to drive explosive long-term demand. The Ocala economy is heavily tied to healthcare, logistics, equestrian industries, and service sector employment. While these sectors provide stability, they don't generate the high-income migration patterns that fuel rapid housing appreciation. Many jobs in the area remain moderate wage, which limits upward pressure on property values compared to finance or tech hubs. Marion County has seen population growth, particularly among retirees seeking lower housing costs. However, that demographic shift brings both opportunity and constraint. Retirees often live on fixed incomes. They buy homes, but they don't always create the same economic multiplier effect as younger professional populations launching businesses or expanding corporate footprints. As a result, consumer spending growth remains steady, but not explosive. Another challenge is infrastructure strain. As more residents move in, traffic congestion increases along key corridors, while public transportation remains limited. Unlike major metros that continue expanding rail or rapid transit systems, Ocala remains car-dependent. That suburban sprawl dynamic can reduce lifestyle appeal for younger buyers seeking walkability or urban energy. Healthcare access is growing, but specialized services may still require travel to Gainesville, Orlando, or Tampa. For some retirees, that becomes a deciding factor when comparing relocation options. There's also the branding issue. Ocala is known for horse country and rural charm, but it doesn't carry the strong tourism identity of coastal cities. Buyers relocating from out of state often imagine Florida beaches, nightlife, and waterfront living. Ocala offers land and affordability, but not the coastal lifestyle many associate with the state. Insurance costs have also crept upward, even though Ocala sits inland. Florida's broader insurance crisis affects homeowners statewide, regardless of direct hurricane exposure. Rising premiums reduce the financial advantage that affordability once offered. Housing inventory has expanded in recent years as developers responded to growth, but increased supply can slow appreciation if demand doesn't accelerate at the same pace. Some subdivisions have seen longer days on market compared to peak pandemic years. In 2026, Ocala remains livable, relatively affordable, and stable, but it lacks the diversified, high-wage economic engines driving stronger growth in Florida's southern and central regions. For many buyers, it's a compromise market: lower prices in exchange for fewer amenities and slower long-term appreciation. That trade-off keeps Ocala from experiencing the same magnetic pull as Florida's more dynamic regions. Number 8. Palatka and Northeast Rural Corridors. Palatka and the broader rural corridor stretching through Northeast Florida represent some of the most economically challenged areas in the northern part of the state. Located along the St. Johns River, Palatka has natural beauty and historical character, but in 2026, it continues to struggle with limited economic expansion. The local economy relies heavily on small businesses, government services, healthcare facilities, and light manufacturing. Unlike Jacksonville, which at least benefits from port activity and logistics scale, Palatka operates on a much smaller economic base. There are few major corporate employers anchoring the region. Income levels tend to fall below state averages. Lower wages translate into reduced purchasing power, which in turn limits housing demand and retail expansion. When income growth stagnates, property values often follow the same pattern. Population growth in Putnam County has been modest. Some residents move in seeking affordability, but outmigration of younger residents pursuing opportunities elsewhere offsets that gain. This creates an aging demographic trend, which can reduce long-term economic dynamism. Infrastructure is another hurdle. Broadband expansion has improved, but rural connectivity still lags compared to urban centers. Healthcare access, while available for basic needs, may require travel for specialized treatment. Retail and entertainment options are limited, which affects lifestyle appeal for newcomers. Crime perception also plays a role in migration hesitation. While not extreme compared to large urban centers, safety concerns in certain neighborhoods impact market confidence. Investors typically avoid regions where long-term growth signals remain unclear. Like other parts of North Florida, insurance costs remain elevated due to statewide pressures. Even areas with lower direct hurricane exposure face rising premiums because insurers spread risk across broader geographic zones. This reduces the cost advantage rural buyers once relied upon. Housing prices are undeniably lower than in most of Florida, but low prices don't automatically create demand. Many relocating families compare job markets, school ratings, healthcare quality, and future appreciation potential. In those comparisons, Palatka often falls behind stronger performing metros. There's also the broader perception issue. For many out-of-state movers, Northeast rural Florida doesn't match the image of Florida that drives relocation decisions. It feels quieter, more southern, more economically limited, and less aligned with the fast growth narrative dominating the state. In 2026, Palatka and similar rural corridors remain affordable and community-oriented, but affordability without strong economic momentum rarely creates a surge in demand. Without significant new industry, infrastructure upgrades, or large-scale investment, growth remains modest. Regions. Number 9. Live Oak and Suwannee County. Live Oak and the broader Suwannee County area represent one of the clearest examples of why parts of North Florida struggle to attract sustained population growth. Located along the I-10 corridor between Jacksonville and Tallahassee, Live Oak benefits from highway access, but access alone hasn't translated into economic expansion. The local economy is rooted in agriculture, small-scale manufacturing, healthcare services, and regional retail. Farming and timber operations remain important, but these industries do not produce the kind of rapid wage growth or corporate relocation headlines that attract outside investors. Many jobs are steady, but modestly paid, which directly limits upward housing pressure. Population growth has been slow. Younger residents frequently leave for larger metros, offering broader career paths. When a region loses its younger workforce, long-term economic dynamism weakens. An aging population can stabilize a community, but it rarely creates the type of business formation or housing demand surge seen in high-growth markets. Healthcare access exists, but is limited compared to urban centers. Specialized treatment often requires travel to Gainesville, Jacksonville, or Tallahassee. For retirees considering relocation within Florida, proximity to major healthcare systems matters significantly. Infrastructure improvements have occurred gradually, but broadband and transportation development still lag behind Florida's booming central and southern corridors. Remote work has helped some rural markets, yet many professionals still prefer areas with stronger amenities, airports, and cultural offerings. Housing prices in Live Oak remain far below the state median. In theory, that affordability should draw buyers priced out of other markets. But affordability without job growth often leads to stagnant appreciation. Investors seeking long-term gains typically prioritize areas with rising incomes and corporate expansion. Insurance costs, again, complicate the equation. Even inland communities feel the impact of Florida's broader insurance volatility. Premium increases narrow the affordability gap between rural North Florida and more economically vibrant regions. Lifestyle also factors into migration decisions. Live Oak offers quiet, rural living with access to rivers and outdoor recreation, but it lacks the nightlife, dining scenes, and large-scale development that attract younger professionals and high-income transplants. In 2026, Live Oak remains stable and community-driven. It is not declining dramatically, but it is not accelerating either. Without major industry shifts or infrastructure breakthroughs, it continues to sit outside Florida's primary growth narrative. That steady but limited momentum explains why large-scale demand hasn't materialized. Regions number 10, Quincy and Gadsden County. Quincy and surrounding Gadsden County sit just west of Tallahassee, yet the economic contrast between the two areas is striking. While proximity to the state capital provides some access to government employment, Quincy has struggled to build its own independent economic engine. Historically agricultural, the region has faced decades of limited industrial expansion. Small businesses and local government jobs dominate employment. Without major corporate relocations or technology investment, wage growth remains constrained. Income levels fall below Florida's state averages, directly affecting purchasing power and housing demand. Population trends have been mixed. Some residents commute to Tallahassee for work, but that dynamic can create a bedroom community effect rather than true local growth. When most economic activity happens outside the county, tax revenue and retail expansion remain limited. Housing prices are among the lowest in the state. On the surface, that appears attractive. However, lower prices often reflect underlying economic constraints. Investors analyze job growth, infrastructure spending, school performance, and crime rates before committing capital. In many of these metrics, Gadsden County trails Florida's stronger performing regions. Infrastructure development has moved slowly. Road improvements and commercial development projects exist, but large-scale transformation has not occurred. Broadband expansion has improved, yet rural gaps remain. Healthcare access requires travel to Tallahassee for more advanced services. For families and retirees comparing options, that distance influences relocation decisions. Crime perception also affects demand. Safety concerns in certain neighborhoods can dampen housing interest and deter outside investors. Even if issues are localized, perception alone influences market confidence. Another challenge is branding. Quincy does not benefit from a strong tourism identity, beach access, or university presence. It sits in a geographic middle ground, close to opportunity, but not fully participating in it. In 2026, Quincy and Gadsden County illustrate a broader North Florida pattern: affordability paired with limited economic acceleration. Without significant new industry, infrastructure overhaul, or corporate investment, growth remains modest. For buyers seeking ultra-low housing costs and rural quiet, the area offers options. But for those chasing appreciation, job mobility, or vibrant economic ecosystems, demand remains restrained. And that's the real story about North Florida in 2026. It's not collapsing. It's not unlivable. It's not some abandoned region people are fleeing overnight. But it is operating on a completely different economic tier than the Florida you see on social media. While South Florida thrives on international capital, luxury development, and finance, while Central Florida expands through tourism, tech corridors, and non-stop construction, much of North Florida remains slower, quieter, more rural, and far less economically explosive. And in today's migration economy, momentum matters. People are moving where jobs are growing. Investors are buying where incomes are rising. Developers are building where demand is accelerating. North Florida, in many areas, simply hasn't had the same catalysts. Lower wages, limited industry diversification, higher insurance costs statewide, fewer corporate relocations, slower population growth, and in some regions, infrastructure that hasn't kept up with modern expectations. That doesn't mean there's no opportunity. In fact, some investors specifically target slower markets for long-term plays. Some retirees prefer affordability and quiet over nightlife and density. Some families want land and space instead of skyscrapers. But here's the key. You have to understand the trade-offs. Affordable doesn't always mean appreciating. Quiet doesn't always mean growing. Cheap doesn't always mean undervalued. And Florida is no longer one unified housing story. It's multiple micro-markets moving at completely different speeds. If this breakdown helped you see the divide more clearly, hit the like button so more people get the full picture, not just the sunshine headlines. Subscribe and turn on notifications because we break down where people are moving, where they're leaving, and what that means for housing prices, insurance, taxes, and long-term opportunity. Drop a comment below. Would you live in North Florida, or is South Florida the only part of the state that feels worth it to you? And share this video with anyone thinking about relocating to Florida, because choosing the wrong region can cost years of appreciation, and choosing the right one can change your financial future. The map is shifting, demand is concentrating, and the smartest move is understanding the difference before you buy. We'll see you in the next one.